Okay, welcome to 6.7. Let's talk about the stock market. Yes. Uh, again, stock market, you can see that picture in the back there. There are channels, magazines, apps, everything dedicated to the stock market. You hear things all the time about, the Dow Jones is up, Dow Jones down, price of crude oil up, down, all that stuff. Stock market is really, really huge in our financial world. So we're going to talk a little bit how stocks are traded. I've already mentioned the benefits and risks of investing in stock. We're going to go a little deeper into it. How corporations raise money through stocks and bonds, how stock performance is measured, and how can you be a wise investor in the stock market. So a share, and again, we talked about this earlier in the topic. A share is a portion of stock. Okay, you own so many shares. Capital gain, when we talk about the stock market, if you buy a stock and you sell it for greater than what you paid for it, that's a gain, and you pay taxes on capital gains. Capital loss would be where I bought the stock at $100 and I had to sell it for $50. That would be a loss. Now, sometimes when you have a stock split, this is where each share splits into two. It's kind of like having twins. You have, one fertilized egg and it all of a sudden divides into two. Well, we have one stock, if it's valued at $100, and it will split into two stocks worth $50 each. Same value, but you have more. And this will make sense when we get into supply and demand, because when the price drops to 50, price drops, demand's going to go up. People are going to buy it. Stockbroker is going to be somebody who links buyers and traders of stock. It'll be in that financial advisor market. Brokerage firms, that would be where the stock brokers work. They specialize in trading stocks. They really watch them. They watch their performance. That's what they do. The stock exchange, that is going to be where we buy and sell stock. Futures. Now, futures are interesting. Futures are where you simply sign a piece of paper and you're kind of gambling on the future. You're trying to predict. Well, I think the price of Apple stock is going to go up in 30 days. So I'm going to sign a contract. Right now it's at $100. I'm going to sign a contract that in 30 days I'm going to buy 100 shares for $50. It's $100. 100 shares for $100. Okay, that's $10,000. Because I'm betting that in 30 days, the price is going to go up to 150. So if I have this contract where I can buy 100 at $100 and then it goes up to 150, I can buy my 100, turn around, quickly resell it. I've made a quick profit. Now, the problem with that is you pay money for that future. If at the end of 30 days, the price has not gone up, the price has actually fallen, I'm not going to use that future and I've lost the money I invested in it. Options. This gives the investor the right to buy or sell stock at a particular price until a specified future date. Again, this is a little bit like a future, but it gives you more of a choice as to what you're going to do. A call option is going to be where it's the option for buying the stock at a particular price. A put option, or put it away, is where you're going to sell your stock. So maybe I have an option with somebody that I'm going to sell my stock at a particular price until a future date. A good example of that would be if you ever go to a car dealership and they say, oh, here's the price on this car. It's good for 7 days. That's a put option. They're giving you a contract that they will sell you that car at that particular price, but it's only good for 7 days. If you ever try to trade in your car, they'll do the same thing. Your car is valued at $5,000, but this trade-in value is only good for 30 days. After that, we have to reevaluate it. You've got the bull and bear market. Bull comes in, rages in, red hot, it's going fast. That is when we have a steady rise in stock prices over a period of time. We call it a bull market. If it's a bear, you think hibernating, they sleep, they're warm and fuzzy, but they're just not really doing anything. That's a bear market. We either have a steady drop or it just kind of stays the same over a period of time. Speculation. This is the practice of making high-risk investments on borrowed money. So in other words, somebody tells me, Apple's really low today, and I think in about 2 months, it's going to double in price. And I'm broke, have no money. So I think, I want to get in on this, but I don't have any money. So I go to the bank, borrow $10,000 so that I can buy Apple stock now, hoping that in the future it's going to go up. And then when I sell it, I can pay off that original loan plus interest and I got a profit in the middle. Sounds fantastic. Like, yes, I want to do this. Give me more of this. However, if I take out that loan and buy the stock and the stock price goes down, I still have to pay this loan back. And if I'm not capable, I get in I put myself in financial ruin. So if you watch the news, you might hear they always have a section on business and the stock market. Stock prices fell heavy today and heavy trading, or if you hear that term, the bulls of Wall Street, that means we got a really strong, fast, hot, stocks are rising economy. So maybe you're interested in the stock market. If you're not interested in playing it directly, you can always have a financial advisor. There are apps on your phone. I know Coach Beaver shows students an app on the phone where you can play with fake money. See how you do. So there are benefits for investing in stock. One, right now with the internet, you can have it on your phone. You can put something here that's right on your home screen and gives you up-to-date minute on the stocks you're invested in or a stock that you're watching to buy. It really is a neat market right now. Now, here's how a stock split works. If you own 50 shares and they're $60 each, that means you've got a value of $3,000. But the price at $60, it's kind of gone stagnant. Nobody's buying it anymore. So the stock will split. So instead of having 50 shares, you now have 100. Instead of them being $60 each, they're now worth $30 each. You can see our investments are the exact same. But now that price has dropped, more people might want to buy my stock. It's going to drive the price up. It's really good for me when a stock splits because that money is going to go up and I have a chance to make more money. And so this is how stock splits. Now, if you decide you want to buy a stock, how do you get started? You've got to use some type of brokerage unless you're going to go straight to the stock market. And you can go see one physically, get a personal relationship. You can do apps on your phone and buy them, several different things. So we have several stock exchanges. We've got the New York Stock Exchange, which is the biggest one. It's all on Wall Street. Many people go visit Wall Street. This is where New York Stock Exchange is and many other brokerage firms. I've never been there. Haven't been to New York ever yet, so I haven't seen this. Again, here is an example on a phone app. You can say best performing stocks. What's the best performing stock? And as you see here, Microsoft is one of the best ones. It's got a percentage change of 2.4%. So that's 80 cents for every stock. It last traded at $33.87. So if you wanted to buy one stock of Microsoft, it cost you around $34. This, I believe this is Cisco. It last traded at $23.07. It went up 57 cents. That's a much higher percentage than this one. And again, you've got the bull and bear market. Bull, our market's doing well. Bear, it's either stagnant or it's declining. If you go to not far from Wall Street, and I've seen several students that go and they have pictures near the bull because I'm like, oh, I want to see that. That's in my econ book. This bull in Lower Manhattan represents the bull markets because that's what we want. We want prices to be rising steadily so people will invest and people will make money. Now, we had a long-term bull market in the 80s and 90s and in the 1920s right before the Great Depression. And that bull market before the Great Depression ended up a major bear market with the collapse. We pretty much had a collapse of the stock market in the Great Depression. Now, in the 1920s, you had all types of new inventions, like the radio. People used to just sit on Friday nights and listen to the radio. They didn't have TVs. And so that was an investment. Some people went into debt. They took out a loan so they could have this radio. Here's the Dow Jones Industrial Average. It takes a bunch of stocks, it pulls them together, sees how well they're doing. So in the 20s, here we go, Great Depression starting to set in. Oh, here's our crash. Okay, here comes our crash. Woo, look at that mountain if you fell down it. Here's our peak. There it goes. Wow. Yeah, it crashed and burned. That's the lowest point it fell to since 1914. So well past here. And I mean, that's a big, if you think that's a mountain and you fell, that's a pretty big fall. If you just kind of fall from here to here, it's kind of not much of a slope. And that is 6.7. That is 6.7. It's the end of topic 6. So happy studying. Look for my study guide video and be ready for the test as soon as you come back.